So it's official, we cannot make any sense anymore of the stock market. When Amazon came out with their numbers, they first started trading 7% lower because they missed on revenue and on guidance. But at the end of the day, the stock skyrocketed to a plus of 15%. Facebook had okay numbers, but got completely slaughtered with a minus of 26%. And Google also had okay numbers, but surprised the market with a stock split. So in average, there will be more stocks, the price goes down and more people can buy into this company so that the value in total will even go higher than it is today. And with so much crazy stuff going on, you might ask yourself, have we topped out or is a reversal very close by? That is a question that we are going to try to answer today. I'm going to show you a few examples of a bear case and a bull case, why we might have been topping out and going low into a recession, or why we already might have reached the bottom of the current correction that we are in right now, and why from this point on we are going higher. So stick around to find out where we are right now. But before we do, of course, always do me a favor, please hit that like button, subscribe, click on the bell, click, and also if you miss anything, leave me a comment, share this video with your friends if you think it is useful. That was very, very fast. Now let's dive into the content of today. So here are a few reasons why the stock markets might be going down. First of all, it is the central banks that are kind of holding back on the current monetary policy. The central bank in America already said that they will stop buying bonds from March on, and they will also very most likely raise the interest rates with 0.25 to 0.5% in March. The other central banks, like the one in England and Europe, are not that far yet, but will very most likely also follow later on this year. If the central bank starts raising the interest rates, then you will most likely see money flowing out of the stock market, going to other assets that give a return on money. So for example, saving and bonds. The third reason for the current drop could be a very high PE ratio. That stands for price to earnings ratio. It's being calculated by dividing the stock price through the earnings per share. A high ratio would say stock is overvalued, and a low ratio would say that the stock is undervalued. The average PE ratio for the S&P 500 is 19.6, so let's say 20. Currently that is hanging around 35.5. And in the last 100 years we have only seen such a high number two times. One on Black Tuesday just before the crash, and one during the credit crisis also just before the crash. The Dow Jones has a PE ratio of approximately 18.7, which makes sense because in the Dow there are a lot of huge companies. They don't have so much future growth in them as some of the S&P 500 companies. On the other hand, the Nasdaq has an average PE ratio of approximately 25, and that's also because there are a lot of tech stocks in there, and usually they have a very high future growth. So it's really like a future story that you're buying in right now. And to give an example, right now Tesla is trading on a PE ratio of 159. So the average return in the market is approximately 10.5% measured in the last 70 years. But if we look back at the average return of the last 10 years, then we're seeing an average return of 14.8%. So if we want to respect a very long-term average, then it would only make sense that the stock market needs a negative return or a few years of a lower than average return just to respect that very long average return in the stock market. And it's good to know that pullbacks of 10% or more happened 11 times in the last 20 years. So in other words, a pullback of 10% happens approximately once every 1.6 years, of 20% happens once every 4 years, and 30% happens one every 9 years. Now interestingly enough, I found an article of CNBC saying that since World War II we had 26 corrections with an average of 13.7%, and it took 4 months to recover from such a correction. Now very important in this is to notice that this is a temporary correction, so that doesn't mean a realized quote-unquote result for the S&P 500 measured over the entire year. So in other words, we can have a correction right now with an average of 13.7%, but we could still end the year on a positive note with an average return. So although the current market correction could be heavily, it doesn't mean that this will be a negative return for the year. Matter of fact, when I dig deeper, I saw in the last 50 years the S&P 500 gave a realized loss, so that's measured from 1st of January till the 31st of December, between 10 and 20% only 2 times, and a drop of 20% or more in the last 50 years measured over an entire year only happened 3 times. And then on the positive side, a return in the last 50 years between 10 and 20% happened 13 times, and a return of 20% or more happened 19 times in the last 50 years. So now let's quickly discuss why the market would just keep on going and keep on rising. This is just a temporary blip on the chart. One of the important reasons is that the interest rate is declining from a historic point of view. Yes, the interest has been rising a few times, but they always created a lower high. I actually should trade something like this. And since the interest rate is declining, therefore a return on bonds and saving is just very small, and especially when you compare it nowadays to the inflation. Therefore money is rotating from bonds and savings into the stock markets, making the prices going higher and higher. But also an increase of the interest rate. Wait, what? Now it sounds weird because I just said the interest rate is decreasing, money is flowing from bonds and savings into the stock market. But it's really depending on how the story is being told to the market. Because if the interest rate is increasing, it could also be explained as a sign of strength in the market, and therefore money is rotating into the market. Matter of fact, data is showing that stocks are rising on average 7.3% over a period of 12 months after an interest rate hike. What we're seeing in the market, that stocks are declining towards the moment of the interest rate hike, and after it really happened, then we're seeing stocks spiking up. So instead of buying the rumor, selling the news, it's more like selling your stocks, buy when it happens. Number 3 is a strong labor market. Right now the unemployment rate is approximately 4%, which historically seen is very low. And if the employment market is very strong, then therefore there's also a lot of purchasing power, which could justify higher prices. Earnings and forecast for a lot of big companies has been very strong, which can be very hopeful for the future. For example, Cisco, Nvidia, Singapore Bank, UOB and Zillow. And last but not least, number 5 is that bad news is very most likely already priced in. We all know that we have inflation. We all know that the central banks are going to rise the interest rates. We all know that there's maybe a possible war in the eastern Ukraine. So none of this comes with a surprise, and therefore we could say that the current decline is already priced in into the market, and we could be bottoming out very soon. Research has shown over and over again that it's just impossible to guess the top or the bottom. Because was the top 4 weeks ago, or is the top suddenly in 8 weeks from now? Is the bottom today, or was the bottom maybe in 4 weeks from now? And especially when you have a bigger portfolio, it is very hard to rotate your entire portfolio from cash to stocks, It is almost impossible to do. So my advice would always be just dollar cost average into the market. Matter of fact, let's say you would have $1,000 and you would have bought stocks on 1st of January 2009 and you would have not sold it for entire 10 years. Then those $1,000 would have grown to $2,775. But if you would have missed only the 10 best days in those 10 years, then you would have done it with almost $1,000 less, which is $1,722. Missing the best 20 days would have only given you $1,228, which is a loss corrected for inflation. Missing the best 30 days would have given you $918, and missing the best 40 days would have given you only $712. So the conclusion is we have no idea what the top is, what the bottom is, how far we can go up, how far we can go down, how long the corrections will be in average. Yes, statistically we should have a drop, a negative year or a bad return, but there's also a lot of reason to think that everything is already priced in. And since we cannot time it, I would say do as always, keep to your strategy, dollar cost average in, don't try to time the market. Keep it cool, keep your rising in 10, 20, 30 years from now, and don't get fooled by headlines and stuff that is happening today. Keep dollar cost averaging every week, every month into the market. And you know what? If the market really decides to tank an extra 10, 20, 30%, then I'm just treating it as a super buying opportunity, and I'm just keep buying it and a little bit more aggressively as what I'm doing right now. Now, if you think this was useful, then show your appreciation by like, subscribe, click on the bell, click, and also if you don't miss anything, leave me a comment, share this video with your friends if you think that is useful. Also feel free to check out the second channel, that's the trading channel. There's a link in the description. We're doing daily videos about Bitcoin and Ethereum. Also in the description you find 2 other links to my Twitter and my Instagram. Feel free to add me there or to check it out. Thank you guys so much again for watching, and see you next one. Bye bye.